Hi, I'm Christine Benz from Morningstar.com. Recent IRS rulings make after-tax 401k contributions more attractive than they were in the past. Joining me to discuss if and when after-tax 401k contributions make sense is financial planning expert Michael Kitces. Michael, thank you so much for being here.
Great to be here, absolutely.
After-tax 401ks have been in the news recently. Let's talk about after-tax 401ks. First of all, how are they different from Roth 401ks, to which people also make after-tax contributions?
So the whole point about after-tax contributions to a traditional 401k is that it is still a traditional 401k, which means your growth is tax deferred as long as the money is in there, and your money is still taxable when it comes out. And so, as you said, like it's a crucial difference to recognize. We're not talking about doing Roth contributions, which also happen to be with after-tax dollars but are tax-free. We're talking about going beyond the deductible contributions in a 401k, adding more on an after-tax basis. So in other words, you're not getting your deduction up front, and it will still be taxable down the road. You just get this window of tax deferral in the intervening time period.
Okay, so let's talk about what has changed in the realm of after-tax 401ks that makes this potentially a more interesting thing to do for a lot of investors, especially high net worth folks who are maxing out their 401ks and IRAs.
So what changes is not just about doing after-tax contributions to 401ks, which frankly have never been terribly popular because you're not really getting the tax deduction going in,
right,
and everything coming out on the back end is ordinary income. So maybe if you had no tax shelters at all, you might put some bonds in there that were going to be ordinary income anyways, and now they'll be ordinary income but tax deferred. But if you were going to put equities and other things in there, it wasn't terribly appealing. No tax deduction, you're going to convert it all to ordinary income. Wasn't done very much. What changed over the past 15 years was we introduced Roths and the idea that you can do Roth conversions. And for a long time, people have been trying to do conversions of after-tax 401ks. And both the opportunity and the confusion that was out there for a long time is, if you put after-tax money in a 401k, so let's say we've contributed for years, there's $100,000 in the account, it includes $15,000 of after-tax contributions we've made over time. When you took the money out, employers would typically send you two checks. The first one would be $85,000, that's all the pre-tax contributions and all the growth. The other one would be $15,000, that was the after-tax amount. So people say, well, I got a great idea. Now that we can do all these Roth conversions, why don't I take the 85 and put it in a rollover IRA, and I'll take the 15 and I'll put it in a Roth. So in essence, I'll convert just the $15,000. Since it's a Roth conversion, it's taxable. But since it's all principal, there's no actual taxable amount. You report the amount as zero, and you just you change $15,000 of after-tax contributions in a 401k to $15,000 of after-tax contributions to Roth, even if you'd already maxed out Roths. And this became more and more popular over the past couple of years, both because Pension Protection Act in 2006, we made it possible to do Roth conversions directly from 401k plans to Roths that hadn't existed before. And then in 2010, we got rid of the income limits. So anybody could do this regardless of the income scale. The problem is when you actually dig into the tax code itself, it wasn't really intended for the two-check rule to be a conversion rule. The code actually said if you do a conversion, you're really supposed to do all of this pro rata. And there was kind of a weird workaround where you would take the money, hold it for a period of time in your checking account, roll it over later, where you could sort of do an end run on the rules. But Class E was supposed to be pro rata, which means if $15,000 of the 100 is after tax, only 15% of every check is principal for a conversion, and the rest would be taxable, and you didn't get a very good Roth conversion treatment. So last year was kind of the surprising event. The IRS basically threw in the towel and capitulated and said, look, since there's kind of this workaround to it anyways, we're just going to open this up and make it much easier to do. And so the IRS said simply, you got a $100,000 check, you get two checks, one for 85, one for 15. You don't have to do the pro rata rule anymore. You can choose wherever you want to allocate the $15,000 of basis, wherever you want to allocate the 85 of gains. And of course, now it's pretty straightforward. You put the basis to the Roth, you make it a tax-free Roth conversion, and you do the rest as a rollover to an IRA. So they basically blessed what was sort of informally being done and frankly sometimes being done wrong in the past because people didn't know about the pro rata rules, and just said, fine, you can do it going forward. You can do these Roth conversions. You
put it a really nice way to me when thinking about these after-tax 401k contributions. It's kind of a deferred Roth contribution. I think that is a helpful way of putting it.
So the IRS blessed this. And like the first wave that we've seen are simply people who had after-tax money in a 401k who said, fantastic, now I can take all the money out, I can split it up, I can convert the after-tax, I can roll over the rest. I basically just get to put money into a Roth and now grow tax-free when my 401k it was growing nearly tax-deferred. But the second wave that comes right afterwards is, well, if I can do that with the after-tax that's already in there, now like I kind of want to contribute even more after-tax money, because I know at some point down the road I'm going to be able to convert it to a Roth. And between now and when I convert it, that growth is still going to be taxable. But once I get to the conversion point, whenever I separate from service or I'm otherwise allowed to take the money out of the plan, I'll actually be able to convert all the after-tax to a Roth. So like I put in $10,000 after-tax now, and 3 or 5 or 10 years down the road, I convert that contribution into a Roth, and so it becomes this like deferred Roth contribution.
Right.
Eventually, I'll get it into the Roth. I just got to wait a while until I can actually do the rollout and the conversion.
Right. So the profile for whom this after-tax 401k would be most attractive is obviously someone who's kind of stuffing all of the money that they can in their tax-sheltered vehicles.
You want to be maxing everything else out first, right?
Let's talk about why this would come later in the funding queue.
So the biggest driver to it is just this recognition. Yes, if I put after-tax money into a 401k, at some point down the road, I can convert it and make it a Roth. But if my alternative is, or I could just put money into a Roth 401k right now, same tax treatment today, it's after tax no matter what, but instead of waiting to convert it later into a Roth, it's a Roth today. I get my tax-free growth starting immediately, not taxable for a period of time until I can roll it out later and then eventually get around to doing a Roth conversion on the contribution. So like we can sort of sequence this out that if I'm going to be doing after-tax already, I really still want to first maximize every after-tax that's just a Roth on day one.
Right.
So I still want to maximize my Roth 401k if I have it available. I still want to maximize my Roth IRA while I have it available. Once I've gotten through those categories, recognizing now that we've crossed a number of people out from realistically pursuing the strategy, because you can get well over $20,000 into Roth 401k plus Roth IRA, and that's already more than just a lot of people have available to save. But once we get through those, this now becomes appealing as kind of the third tier afterwards. All right, we're done with the Roth contributions in the 401k. We're done with the Roth contributions in the IRA. I have more money that I want to contribute. I'm trying to figure out where to put it now, and this becomes a new window that's available. Okay, I'm going to do after-tax contributions. I'm done with immediate Roths.
Right.
Now I'll do the deferred Roth.
Right. So this would come, though, ahead in the funding queue of just putting money in a taxable account, right? I mean, there's important tax advantages.
Generally
here.
Still more appealing than putting in a taxable account. You get, at worst, tax deferral while the money's still in the plan. You know you're eventually going to be able to do a Roth conversion and make that growth tax-free down the road. Realistic, I mean, if there's someone who's working now and they might not leave the company for 30 years and you're going to have like 30 years worth of taxable growth before you finally get to the Roth conversion. I can imagine someone might decide that they'd rather just kind of do it on the side in a taxable account and get their preferential capital gains, particularly if they've got low turnover and they're a buy or hold investor.
Yeah.
But realistically, I don't know very many people who are in their 20s and 30s and are making retirement contributions envisioning that they're going to be at this company for 30 years and that they're going to leave it in the 2040s.
Right.
Right. Like our workforce is a little bit more mobile now, and because every time you have a job change, the 401k becomes liquid if it wasn't already, and you have the opportunity to do the rollover and the conversions. Realistically, I expect a lot of people are going to find this appealing versus just taxable accounts, because it's probably not that far out until they're going to have the opportunity to do their deferred Roth conversion. Okay.
One question I've gotten on this topic is, particularly for people who work for smaller employers, could a lot of people stuffing money into the after-tax 401ks lead the plan to run afoul of some of the non-discrimination policies in place without getting too far in the weeds about what those are? Is that a risk?
It is a risk. So like first and foremost, just for anybody who's listening who wants to do after-tax contributions, their 401k, like first and foremost, your plan has to allow this. It's not an automatic thing. Just because you have a 401k doesn't mean the plan will also allow after-tax contributions above and beyond the initial 401k limits. So kind of caveat number one is the plan has to allow it. We see a number of large firms that do, a number of small firms generally don't, but often in small businesses, since it's their business, they control it and they want to add it in. Now, the caveat that comes up is, as you've alluded to, so there are rules for 401k plans that limit essentially how much the highly compensated folks put in relative to everybody else. Now, when you get a really large corporate environments, these rules rarely become an issue. So there's so many people involved that the numbers tend to average out. When you're a small business, there's 8 of you, 2 owners and 6 employees, and the owners are highly compensated and the other 6 are not, and the owners max it out, and the lower income employees, often younger, don't have as much to save, don't contribute as much, you potentially run afoul of these rules and create some problems. So kind of at a minimum, if someone's looking at this in a small business environment or wants to add it to their plan in a small business environment, they need to talk to their qualified plan consultants about, can we actually do this given the kinds of dollars that we put in, and not run afoul of the rules.
Okay.
The other thing actually that I'd note for small businesses as well. So there's sort of 3 different ways that money ultimately gets into a qualified plan in general. We can put in 401k contributions, we can put in profit sharing contributions from the company, and we can try to put in after-tax contributions as well. For a lot of businesses, particularly in small businesses, just the first 2 categories, their salary deferrals for 401k and their profit sharing, actually maxes out the entire plan. So there's a limit as to how much a person can have in all dollars from all sources going into a qualified plan. It's about $53,000 a year. It gets adjusted each year for inflation. So actually, we also see a lot of small businesses, they don't actually need to go down this road. It's not going to help them because they're already hitting the limits just with their profit sharing contributions and their 401k salary deferrals already. But if you have a gap, if you're not otherwise maxing it out, this becomes an opportunity. And then a lot of large firm environments, they're often not maxing it out, and this becomes an opportunity.
Okay. Another big question mark lurking out there is whether this idea of making after-tax contributions could face some legislative risk. Could Congress look at this, say, hey, this is a loophole for affluent people, maybe something we want to shut the door on?
There is legislative risk to this, and it's actually now been acknowledged in Washington. So President Obama's budget that came out this year actually had, for the first time, basically the proverbial loophole closer that would unequivocally shut this down. It would actually shut this down, as well as the infamous backdoor Roth contribution, where you do non-deductible contributions to an IRA and convert it. And the wording in the rule is very straightforward. It simply says if you have after-tax money in an IRA or a 401k, you can't convert the after-tax portion. And that would be that. Right. So there is legislative risk to this, particularly recognizing that with something like after-tax contributions to a 401k, you really do legitimately have the possibility that you will still be working for the company and not be able to roll the money out, and they'll change the rule in 2017. And you don't even have a workaround. There's just no solution. You're going to find the after-tax contributions you made that you thought you were going to convert down the road are just going to remain after-tax contributions in a 401k forever.
So you still get the tax-deferred compounding.
You still get the tax-deferred compounding. It's not necessarily the word, like, darn, I only have tax-deferred growth for life is not the worst thing in the world. So you're not necessarily damaged and worse off, but you may not get quite the benefit that you were expecting out of it. And the fact that Congress clearly now has this on the radar screen. Realistically, I do think there's some danger to this. I mean, it really is perceived as a loophole, not the least of which in the IRA context, because the strategy has literally been dubbed backdoor Roth contributions. So like you couldn't put tax abuse, you couldn't put like a worse label on it to call it tax abuse if you wanted to. So I do think there's a perception from Congress that that this is a form of loophole abuse and that they may shut it down. And particularly since it's relatively easy to do so in a tax context, you simply say there's no such thing as conversions of after-tax IRAs and 401ks anymore. And that would be that. So at least be cognizant it's out there as a risk. If you're going to start pursuing the strategy with the hope of doing a deferred Roth contribution down the road, recognize that conversion opportunity might not actually be there when the time comes.
Okay, Michael, always great to hear your insights. Thank you so much for being here.
Absolutely, my pleasure.
Thanks for watching. I'm Christine Benz from Morningstar.com.